Today's episode of Market Talk is brought to you in part by GrowMark FS. Keeping up on the latest in ag is a challenge, to say the least, but there are experts nearby ready to help. You'll find them at your local FS. You can trust them to bring you customized agronomic grain and energy solutions born of the latest thinking. That's because FS specialists receive continuous training that keeps them current on the latest trends, practices, and technologies. So you'll get local expertise that's both exceptional and up to date. Visit fssystem.com to learn how FS is bringing you what's next. And a good afternoon. Welcome into Market Talk. Thank you so much for joining us here on the show. Once again, I'm your host, Jesse Allen. Thank you for being a part of the Market Talk family. You can find us online. MarketTalkAg.com is our home on the web. You can find all of our streaming sources, including Apple Podcasts, Spotify, iHeartRadio, and more. All of our radio affiliates, our social media accounts. You can follow along with us there. It's all online at MarketTalkAg.com. Well, I always enjoy getting a deeper dive into the overall market trends and what's going on in the market trade. And I know a lot of folks like you do as well. And for that today, we bring in our good friend, David Widmar with Agricultural Economic Insights, AEI. David, great to have you back on Market Talk. How are you, sir?
Great to join you, Jesse. Great to join the listeners as well. Thanks for having me back.
Of course. And, I feel like the more things change, the more they stay the same. You and I talk about once a month, and it always seems like something changes in the market trades in the short term, but then overall, the big picture, it all kind of just stays the same. The volatility that's out there and everything else in this market trade, but a lot of things for us to catch up on. And I know the market picture is a little different than it was here about a month ago when we talked. And we're coming off that June 30th USDA stocks and acreage reports, and I think starting there, what are your overall thoughts as we get those numbers in and we move now into the month of July, looking at this grain market overall? What are your thoughts after those reports, David?
Well, the first way I think about this is the market reaction the day or two that followed, which was wow, up very strong. We really have to sort through a couple pieces. What were the market expectations and what's the balance sheet look like? And we saw a scenario here where the market expectations were for big acreage response. Some of the stuff that I was reading and that I saw was the market was trading expectations somewhere from 181 million combined corn and soybean acres up to 186 million. And we came in at 180 and change. And so it fell to the low side of that expectations. And so that gave us that big pop in commodity prices. Caused a lot of question about the supply response, and there's a lot of stuff that goes into that, and we won't hash that out right here. But I think the other thing to really back up and look at is what are the impacts on the USDA's balance sheets, that WASD balance sheet. And if you just untangle market expectations with the supply and demand balance sheets, you see a scenario where soybeans were unchanged on acreage. So we're still at this 3.5% stocks to use ratio, which is tight in a historic context, but less tight than it was for the 2020 crop. Then we have corn, which actually gained 1.5 million or 1.6 million acres of production, which if you just drop that new number in, you don't change the rest of the balance sheet, it is a growing stock situation. And so still tight. So we have to untangle this a little bit is, where are we in the fog of this decision making? On one hand, the market was caught by surprise, but on the other hand, this is still a production number that got a little bigger. The one thing I also want to remind folks of is where we were in January and February when we were talking about acreage. We came into the 2021 with a historic strong soybean corn price ratio. All signs looked like we could plant a really big soybean crop, but the economics of corn production for a lot of reasons were pretty favorable. And so we sort of backed away from one of the questions we asked at the beginning of the year is the idea of not more than 91 million acres of corn and more than 91 million acres of soybeans. And everyone going into this report was pretty confident we get more than 91 million acres of corn and less than 91 million acres of soybeans. But it's interesting to see where that conversation we were having back in January when everyone was thinking maybe more acres of soybeans than corn.
Yeah, very, very true. And, all of this translating moving forward We have all the other legs of the stool, so to speak, that are kind of our volatile factors, on a day in weekly basis. And I know weather's been a big story, and we mentioned looking at that acreage and looking at corn acreage going up, but obviously the weather issues in the Western Belt have been a big story, continue to be. And I know I've talked to play producers, you have, we're both traveling, and we hear the narrative that there's a lot of trouble out there. And then we also hear folks say, well, we could catch a rain or two or three and we'd be okay. What are your thoughts on this weather story and how that wraps into the numbers that are out there from USDA, et cetera?
Well, all eyes are now on the growing season, right? All eyes are going to be on the yield story, and there's a lot of pressure on the yield because if we do have a big hiccup, the market's going to have to ration usage because they're just not the stocks to absorb that. So that's a good thing on the markets. If you're a corn grower or soybean grower, if you want a big price response, it's got to come out of usage, price rationing, and so there's just not the stocks to offset that. Now, I have tried to be very, very careful with my thinking about the dry situation. And a few things that we've worked on and we've wrote about is, first off, drought maps are very, very hard for us to look at. And a map of the United States will bias your thinking in ways that you don't even know about. And so we look at these drought maps and they look very familiar, but in a lot of ways, we have to know the base rate. How much of the US is always experiencing drought? How much of the US corn crop is going to be a crummy crop? There's always some part of the corn belt that's collecting insurance for corn or soybeans. There's millions of acres that are always disappointing in their production. So we have to be very careful. We always have to think about the base rate. What is normal? And we see a lot of these charts of X million acres or X percent of the corn crop in dry and drought conditions. The second thing I think we have to be very careful of, and we've wrote about this in the past, is that a dry or drought condition isn't necessarily perfectly predictive for a bust in the yields. And so timely rains are very important when you think about this. And so we've looked at the data. It's actually about this time of the year in the middle of July. What percentage of the corn crop is in drought, and how does that play out with the final yield? Is it above or below trend? There's just not a great relationship there, especially if you take out the 2012 relationship. It's just sort of all over the place. You can have a big part of the corn belt in drought and still have pretty decent yields. And so, of course, we have to be careful with our thinking, and we have to be very careful in our how we think about that. But July is important for corn. August and early September are important for soybeans. And so we're sort of zeroing in on this yield story. And so it's important. I encouraging listeners to always think beyond their backyard and always think beyond what they see on Twitter. Someone posted a picture of good crops are always, wide angles, and bad crops are always narrow angles. And so you always got to think about how these pictures might be distorting it. And at least for me, drought maps really bias my thinking in a lot. And so I always have to be careful with those drought maps and how I interpret that into my thinking.
Well, David, I know you mentioned the things that you guys write about and are released on AEI.ag on the premium side. And one of those things I wanted to talk about, we know there's a lot of money flow in these markets. And this is a story that's definitely out there. Maybe it's taken a little bit of a backseat in the headlines, so to speak, but inflation. We know inflation's out there. It's a story that's not going away. A lot of folks are talking about that and how inflation is playing into agriculture right now. What are your thoughts on where inflation is headed here as we work through the rest of 2021, David?
Well, that's a great topic. It's an important topic. I think you could create a very catchy newsletter or a podcast or a sensational headline by just inserting a noun, a verb, and the word inflation, because that is sort of wrapped up. It's the boogeyman that's out there explaining everything. And I think there's a lot of concern about inflation, but no one's actually talking about anything specifically. And so the first thing I want to challenge listeners to think about is, what do you think about when you think about inflation? And everyone goes back to the 70s and double digit inflation. Well, we hit double digit inflation twice in the 70s and early 80s, but it was actually a decade of persistent inflation that was actually the problem. So prices across the whole economy roughly doubled in a decade. And so we sometimes put too much emphasis on the double digit number and not enough emphasis on this running average. And when you think about the running average idea, is inflation's probably been too cool the last decade. I think it's averaging about 1.5 or 1.6%, which the Fed's saying they want 2%. So we really have to balance these narratives. We're encouraging people to think about what's the probability of us having higher than 3.5% inflation as measured by the PCE index, which is what the Fed is watching. Right now, the Fed thinks 3.4% is in the cards. They've been raising their expectations over the last several months. But the narrative that they're watching and they're thinking about is one, the idea of transitive inflation. So as the economy sort of gets its feet back underneath it, we could expect some transitive inflation. So this could be sort of a temporary or a short term. And here's an example I want to share is if you go book an airline ticket, the prices are pretty full, the airplanes are pretty full. But you can land in certain airports, and Kansas City is one of them, where you land and there's still dozens of airplanes being mothballed, right? They're still idled. And so there's this idea of idle capacity. And so the tickets are pretty high priced. There's idle capacity out there. And so we're in this transition as we start to bring those back online. The second thing I want to point out is we're going to see a bit of an economic boost. We're going to see the economy is going to feel like it's moving really quickly, especially when we measure it relative to last year, because last year was sort of the gutter. So when you measure things out of the gutter, it starts to feel like it's a pretty big boost. And then finally, one thing that we're looking at is the Fed wants a 2% goal, and they want to sustain that, and they want to see that above 2%. So they haven't even started to tap the brakes on inflation yet. They want to sort of make sure they can sustain it, and then they're going to ease into it. And in our opinion, something like 3% or 2.5% or 4% is not something that folks are really talking about as a concern. It's that double digit, but we think that 3% could have a very significantly different impact on the economy, considering we were coming from a 1.5% environment over the last decade. So I guess a lot of concern about double digits and probably not enough concern about something around 3.5%, which could very well be in the cards.
David, I'd love your thoughts on this as well, kind of piggybacking off the inflation story. You know, we've been hearing more about farm debt and some of that being paid down, so to speak, with the higher prices out there, the profitability that some farmers have experienced with higher, commodity prices here the last few months. But what are your overall thoughts on that? I know we just saw the recent ag economy barometer fell again, so maybe there's some waning sentiment in farm country about the future of the ag economy moving through the rest of the year. And I mean, looking at just the debt side of farm economy, I know you guys have wrote some articles on this as well. What are your thoughts on that picture here as we move into the back half of 2021?
So Jesse, I like how you frame this up, and there's sort of two components. We'll talk about the outlook of the farm economy a little bit, and also the debt side. We just haven't seen farm debt really slow down or decrease on an aggregate level. I sort of thought we'd see it back in 2014 when commodity prices tumbled. Like, well, then I changed my thinking. I said, well, maybe producers are going to need more debt to get through the lean years, and we just keep continuing to see that trek higher. So there are a lot of things that impact the decision to use debt, and profitability is one of them. And so there's kind of a couple ways to think about, oh, I'm profitable, I can now service more debt. Or the other idea is, I'm profitable, do I retire some debt? And by a large part, we haven't seen a lot of widespread retirement of debt in the farm economy. Now, in fact, total farm debt's probably inflation adjusted, probably some of the highest levels we've seen in the past, which could raise some alarm bells for some listeners. But there are two things that I'm watching. One, interest rates, inflation's cousin, sometimes the evil cousin. And interest rates are historically low. In fact, career lows here we saw in 2020. So very favorable interest rate environment. And the second thing that's kind of under the radar is the repayment terms. And so we actually have very long repayment terms, much longer than what we would have saw 4 or 5 years ago, and even a decade or two ago. So when you combine low interest rates and long repayment periods, you actually get a debt service environment that's very, very favorable. So in fact, it's probably a career low. So we look at this machinery index. If you want to finance $1,000 of machinery debt, how much does that cost you per year? and it's at the lowest we've seen in the past. So the serviceability of this debt is very low. So I think that is appealing for those looking to maybe deploy more debt or use debt. We're also looking at the 2022 side of the equation, the profitability, and we got a whiff of this with fertilizer prices in the spring. But there is one thing that's certain when we have strong profitability in agriculture and strong commodity prices is the costs of production are going to go up. And usually the best year in agriculture is the year where the first year when we had the commodity price boom, because costs of production can be slow to respond. And now we're looking at 2022 budgets, and you see a scenario where we could see costs of production increase considerably. Now, still profitable, still a profitable outlook, very favorable outlook, but not as optimistic as 2020, or not as profitable as maybe 2021 looked like on the budget. And this higher cost structure, producers are going to need to keep a careful eye on cost structure.
Well, David, all great insight as always. And I know folks, again, could see a lot of articles and be able to use a lot of the tools you have available through the premium side of AEI.ag. And any other final thoughts you have for us here today? Just looking at this farm economy in general, looking at everything, looking at the markets, anything else you want to highlight today or reiterate for us?
Well, I mean, I think it's always important to challenge our thinking a lot. And so, one of the things we want to challenge our thinking of is what are your expectations for this national corn crop and what would make you change your mind? I want to make sure that producers are really thinking about this marketing situation. We just don't have that many opportunities to sell grain at these levels. These are very profitable levels. And the second part is start thinking about your cost structure in 2022. Yes, fertilizer is going to be up, but watch those fixed costs such as cash rent, family living, machinery, debt service, all of the cash flow expenses that you're going to have. So it's a very stressful time for producers. We have to be very disciplined in how we pursue and how we go forward in the next 6 to 12 months.
Well, and I mentioned the website, David, AEI.ag, and I know folks can go there and sign up for the premium side and be able to check out a ton of great information that you guys have there, can't they?
Yes, AEI.ag. We have the Escaping 1980 podcast that we've talked about in the past. It's available anywhere they listen to podcasts, and you can learn more about the premium at AEI.ag as well.
David, appreciate the time as always. Thanks for joining us here this month, and I look forward to catching up with you again soon. Thanks so much.
Thanks, Jesse.
David Widmar with Agricultural Economic Insights, AEI.ag, the website. You can find them and learn more. This has been Market Talk, brought to you by GrowMark FS. I'm your host, Jesse Allen, wishing you a great rest of your day.